Hey everybody, Rob Maurer here, and today we are talking about some breaking news on Tesla stock. Tesla's investor relations team in the after-hours session today announced that Tesla will be doing a 5-for-1 split on Tesla stock. In the after-hours session right now, as I'm recording, Tesla is trading up about 6% on the news after finishing the day down 3%. The statement in full from Tesla reads, quote, Tesla Inc. announced today that the board of directors has approved and declared a 5-for-1 split of Tesla's common stock in the form of a stock dividend to make stock ownership more accessible to employees and investors. Each stockholder of record on August 21st, 2020, will receive a dividend of 4 additional shares of common stock for each then held share to be distributed after close of trading on August 28th, 2020. Trading will begin on a stock split adjusted basis on August 31st, 2020. End quote. So if you're not familiar with a stock split, pretty simple concept. Basically, for every share of Tesla that someone owns, they will be granted 4 additional shares, meaning they would then own 5. At the same time, the stock price will then be reduced to 1/5 of the price that it is trading at that time, meaning there is no change to the valuation or the market cap of the company. So for Tesla, this will happen after the close of trading on Friday, August 28th, and then on Monday, the trading will start at the new lower price with the additional share count factored in. So if Tesla is trading at $1,500 per share at the end of the day on that Friday, and you have 1 share, on Monday, you'll have 5 shares, each at $300 apiece. I'm sure people have similar questions about option contracts as well. Because this is a 5-for-1 split and not something a little bit weird like a 3-for-2 or something like that, all options contracts will be adjusted in pretty much the exact same way. So if you had 1 contract for buying Tesla at $1,500 per share, for example, that will just become 5 contracts for buying Tesla at $300 per share. Same math. So let's talk about the pros and the cons of a stock split. Obviously, there's no actual change to the company in terms of the valuation. This is really just an accounting thing. But the biggest pro is obviously that the stock price becomes more affordable to potentially new investors, or even to investors that maybe just want to add 1 or 2 shares every month and can afford to do that if the stock price is above $1,000. Over time, this benefit has become less significant with the advent of fractional share trading. A lot of different brokerages are offering that now. So before, you could have bought 1/5 of a share of Tesla for $300. That's often presented as making a stock split irrelevant, but that's not a perfect solution. There are voting rights issues with that. You don't have a right to vote if you only own 1/5 of a share. Generally, obviously, that's not going to make a difference, and some services do correct for that, but it is still a problem. More importantly, though, not all brokerages offer fractional share trading, especially internationally, which means by default, there are some investors that don't have access to the number of shares that they would like to buy. The logic then follows that if you do a stock split, you're opening up the possible investment to more investors. That is what Tesla supplies as the reason here. They say to make stock ownership more accessible to employees and investors. That's what a stock split does. Even for those brokerages that do offer fractional share trading, there are often limitations on those. For example, some don't let you do limit orders, only allowing market orders for fractional shares. So I think that's the biggest one, and there are knock-on effects to that. If someone is able to buy Tesla stock, they're probably more likely to follow the company more closely and perhaps eventually become a customer, whether that's something as simple as merchandise or eventually a vehicle. And I think they're also much more likely to talk to their network about the company and about their products. So I think those secondary impacts are pretty important as well and can actually help with the fundamentals of the business. There is also some research that shows that stocks that undergo stock splits then end up outperforming. One study that tracked the performance of 1,275 companies that underwent a 2-for-1 stock split between 1975 and 1990 found that those stocks outperformed a control group by 8% in the first year and 16% over 3 years. A similar study from 1990 to 1997 using companies that did a 2-for-1, 3-for-1, or 4-for-1 stock split found similar results, 8% overperformance in 1 year and 12% over 3 years. Obviously, though, correlation does not equal causation. It seems more likely to me, at least, that companies that have done well and that project to continue doing well in terms of the share price performance are more likely to do a stock split than those that have not. But taking that a step further, that means that a stock split is essentially a sign of confidence. Essentially, management believes that the share price is unlikely to fall significantly, or there would be no incentive to do a stock split, and perhaps they continue to believe that the stock price will rise, creating more of an incentive to do a stock split. Companies don't want their share prices to get too low, and certainly they don't want them to be lower than they IPO'd at, for example. For similarly psychological reasons, it then just starts to look like your stock has actually underperformed. So if you do a stock split, you're expressing confidence that that's not going to happen. And I think that adds a nice little psychological benefit to the announcements of stock splits and probably plays a pretty big role in why we see stock prices jump on the days that stock splits are announced. The other possible benefit is that some indexes are actually determined based on share price weighted methodology. The Dow Jones is the most popular example of this. Personally, I think that sort of methodology is horrible because share prices are essentially meaningless. It seems much better to use the valuation of the market cap to me personally. But anyway, the stock prices in the Dow range from $38 at the bottom with Pfizer and Apple at the top at $438 per share. So Tesla, when it splits, will be somewhere around $300 per share. That would put them right now at third in that index if the Dow Jones were to want to add Tesla. I mean, I would obviously do it if I were them, but I think it's probably unlikely that they would add Tesla at that weighting. I think a 10-to-1 split would have made the odds of that much higher. In general, I think a stock split is mostly positive, but getting into the cons, there are a few. Some brokerages do still charge per share for transactions, so potentially for some investors, it does become more expensive per share to acquire Tesla, and that's even more common for options trading, so a lot of brokerages will charge per contract. Now you'd have to buy 5 times as many contracts for the same exposure. For people looking to buy options, that is offset by the lower cost of entry, which, similarly to the share price, is now 5 times lower. I think for many investors that will be a welcome change. Option contracts on Tesla had gotten quite expensive, tens of thousands of dollars, unattainable by many, but I do actually think to Tesla that is a con, especially for a company that is watched as closely as Tesla, that is as volatile as Tesla, and is as attractive to new investors as Tesla is. I think the lower cost to entry for options positions encourages more speculative trading on the stock, especially for newer investors or newer options traders. And because of that, that could subject the underlying asset, Tesla stock, to be subject to a bit more manipulation so that market makers can profit off of such speculation. I do also worry that it creates a situation where investors more frequently choose to opt for the exposure from options contract versus the underlying shares, which is not actually beneficial to the share price since you don't actually own the shares yet. Taken to the extreme, if nobody bought the actual shares and everybody preferred to buy options, the stock price would go to zero because no one would buy it. Obviously, if it falls far enough, people would buy it. That's just an example of sort of the logical path to explain the possible negative impact that more investment in the options of the underlying asset could have. Those impacts in the option markets are probably the biggest downside to me. There is also the obvious one, though, of it just is a lot of paperwork for Tesla. That's not free. There are costs to Tesla to do this, but obviously overall pretty inconsequential. Let's see, another couple things here that I haven't mentioned yet. Liquidity, it does tend to increase liquidity, at least in the short term, though there is some conflicting research on the long-term improvement there. As for volatility, I haven't been able to find a ton of research on this, but one study that I did find suggested that there is actually an increase in volatility after splits for large cap companies, though they say that after a short period of time after the split, that does return to normal. And then probably just one other anecdotal point that I wanted to mention in terms of just becoming more affordable and increasing the investor set. I definitely have had friends that have said Tesla stock is just too expensive for them to buy. Maybe they're just not aware of fractional shares, or it's just something as simple as a psychological thing that $1,500 per share is just too much. Things like that, even if they aren't grounded in any sort of valuation, and even if the people can actually afford the stock, that perception does still exist. And I think even for more seasoned investors, obviously not professional level, but some of those psychological tendencies, I guess, can still linger, I think. So I do think the stock split does help combat those things. I think probably the other aspect that people are wondering about is if this has any relation to possible inclusion in the S&P 500. I don't really know. I'm not sure that there's any research on that out there. I don't see why it would. Maybe the slight benefit for increased liquidity would help with the S&P inclusion process, but I'm probably not informed enough to speak accurately on that topic. What I will say is that the timing is definitely interesting. Remember, Elon had previously tweeted that a stock split was something that should be discussed at the upcoming shareholder meeting in September, and yet Tesla is now going ahead and doing that stock split before the meeting anyway. So who knows, the timing could be unrelated, but it is interesting. Putting everything together, weighing the pros and cons, I am in favor of the stock split. I'm okay with the 5-to-1 level. I had been prepping an episode on the stock split before this, and my recommendation was going to be for Tesla to do a 69-to-1 stock split. Number one, because I think it fits the ethos that Elon has created around Tesla, and number two, I think it highlights the sort of arbitrary nature of stock splits in general. So I think it would have been a meta way for Tesla to sort of make fun of doing the stock split in the first place. And then the third and probably best reason is the amount of free additional press that it would have generated. Obviously, a lot of financial publications are going to cover the stock split as it is, but that coverage would have attained a much broader reach just because of the humor and sort of sheer ridiculousness that it would have carried. And I think that's important, as we talked about before, when it comes to even making investors aware that, hey, Tesla stock is now affordable. And it just carries some of that personality that's so often dead from corporations that I think really helps Tesla connect with customers. That split would have put Tesla around $21 per share, so it still would have been above the IPO price, though probably too close for comfort for Tesla, but still well above the point of any risk. I think to be on the NASDAQ, you have to be above $1 per share, so Tesla at that point would have had to decline by 95% or so to be at risk of being excluded. So I think it would have been fine. A bit disappointing. I think it's a missed opportunity from Tesla, and one that they'll never probably have an opportunity for again. But obviously, no big deal. So that will wrap it up for today. As always, thank you for listening. Don't forget to subscribe and sign up for notifications. Make sure you're following me on Twitter at Tesla Podcast. And I'll see you tomorrow for the Wednesday, August 12th episode of Tesla Daily. Thank you.